Right. Today we're doing a deep dive into exchange-traded funds, ETFs. This stuff is obviously central to markets today, but it's absolutely critical for you nailing the CFA Level 2 exam. Our goal is to really get under the hood, understand not just what they are, but why they work the way they do, and what that means for analysis.
Indeed. ETFs, they bring incredible flexibility, cost efficiency, but to really use them well, and honestly, to get those exam points, you need to go deeper than just the basics. We'll look at how they're born, basically, how costs actually bite into performance, and those strategic risks and uses you absolutely have to understand.
Yeah, we talk a lot about buying and selling ETFs on an exchange, like a stock.
Yeah.
But the real kind of genius, maybe, or the mystery for a lot of people is how they actually come into existence. It's not like a mutual fund where you buy from the fund company at the end of day NAV. ETFs trade all day. But the real action is behind the curtain in the primary market.
That's exactly right. The core is this creation and redemption process. And the key players are authorized participants, APs, big institutions usually. They
Right.
do this in-kind exchange. That means they're swapping a basket of the actual underlying stocks or bonds for a block of new ETF shares, or vice versa. Crucially, often without cash changing hands initially.
Okay? In-kind securities for
So
share.
yeah, and this happens continuously. It's what anchors the ETF's market price, ideally, close to its net asset value, the NAV.
And this primary market thing, the creation redemption by APs,
Yeah.
that directly impacts what you, the investor, see on the exchange, right?
Yeah.
It keeps the price honest.
Precisely. It fuels the arbitrage mechanism. If the ETF price in the exchange drifts above its NAV, a premium APs have an incentive. They can buy the underlying basket of securities relatively cheap, swap it for new, more expensive ETF shares via that creation process, and then sell those shares on the exchange for a profit.
Ah, okay. And if it's trading at a discount, below NAV.
They do the reverse. Buy the cheap ETF shares on the market, redeem them with the issuer for the underlying securities, which are worth more, and sell those securities.
Got it. So they make money on the small gaps, and that very action pulls the price back in line. A kind of self-correcting thing.
Exactly. It's a really core difference compared to traditional mutual funds, working constantly in the background.
Okay, so costs. Everyone talks expense ratios, and yeah, they matter. But what are the true all-in costs? What else should we be really digging into?
Great question. Beyond the management fee, a huge one for analysis, especially for the exam, is tracking error. How well does the ETF actually follow its index? Sources vary. Fees are one, obviously, but also representative sampling. Sometimes for really broad or illiquid indexes, the fund doesn't hold every single security. They hold a statistically similar basket.
Right, to save on trading costs, maybe. But it introduces a potential difference.
Exactly. It's an efficiency choice, but it creates deviation. Then you have index changes, rebalancing costs, even the fund's accounting choices or tax handling can play a role. And keep this in mind, tracking difference. The actual cumulative return gap over time is often more practical than just looking at the standard deviation of daily differences. It shows the real impact on your return versus the index.
Okay, tracking difference. Got it. What about the costs when you actually, buy or sell?
Right, transactional costs. Bid-ask spreads are key. That's a direct cost, especially for frequent traders. It depends heavily on the liquidity of what's inside the ETF. So things like small cap international stocks or maybe some niche bonds, you'll likely see wider spreads there. Competition among market makers matters too.
In premiums or discounts to NAV. You mentioned the APs keeping things tight, but gaps can still happen.
They can, often due to timing. Think about an ETF holding Japanese stocks trading in New York when the Tokyo market is closed. The underlying prices are stale. Or maybe the underlying assets themselves are just very illiquid, hard to price accurately moment to moment. In these cases, sometimes the ETF price itself can offer price discovery. It's giving you a more real-time sense of value than the last traded price of the underlying assets.
Interesting. So the ETF price might actually be leading the underlying in some cases.
It can happen, yeah.
So the big picture on costs. If you're trading a lot, spreads and commissions are huge if you're holding long term. That management fee and the tracking difference really add up. You need to consider both.
Absolutely. Understanding that trade-off is vital, but, even the cheapest, most efficient ETF isn't without some unique wrinkles, some risks.
Right. Let's pivot there. What are the specific risks we need to flag with ETFs? And then importantly, how do we actually use these things strategically in a portfolio?
Okay, risks. A critical one, especially for level 2, is counterparty risk. This hits hardest with exchange-traded notes ETNs, big exam point. Remember, ETNs aren't funds holding assets. They are unsecured debt obligations of the issuer, usually a bank. So if that bank gets into trouble, you might not get your money back, regardless of what the underlying index did. It's credit risk.
Yeah, ETN's unsecured debt. Big difference. What else?
Fund closures, ETFs can get shut down. Maybe regulations change. Maybe they just don't gather enough assets to be viable. Maybe there's a merger. This can force you to sell at an inconvenient time. And importantly, it can trigger unexpected capital gains taxes for you.
Right, not ideal.
And then there are the complex ones like leveraged and inverse ETFs. The math here is tricky because they usually reset daily. Their long-term performance often doesn't match the simple multiple like 2x or -1x of the index return over that longer period. That compounding effect trips people up. It's a major investor-related risk.
Okay, so daily reset on leveraged inverse. That's key. So despite these risks, they're obviously everywhere. How do we use them effectively in portfolio management?
Oh, hugely versatile. First, portfolio efficiency. Think quick cash management, parking cash in a short-term bond ETF instead of just letting it sit. Or efficient rebalancing back to target weights. Or maybe bridging a gap while you're changing managers, use an ETF for temporary exposure.
Make sense? Quick, easy exposure.
Second, asset class exposure. This is the bread and butter. Strategic long-term holdings in broad market ETFs or tactical tilts. Maybe you want short-term overweight to energy or tech using a sector ETF. Thematic ETFs fit here too, targeting specific niches like robotics or clean energy.
And beyond just tracking broad indexes.
Absolutely. Third is active and factor investing. This is where smart beta ETFs come in. They track indexes designed to give you exposure to specific factors like value, momentum, low volatility, quality. So you're not just passive, you're embedding an active view or risk management preference, like trying to reduce portfolio drawdowns with a low volatility ETF, but still using that efficient ETF structure.
Wow. Okay, so from the detailed mechanics of how they're created with APs, through all the layers of cost, the specific risks like counterparty risk for ETNs, right up to using them for tactical tilts or factor investing. Understanding all this is way more than just ticking boxes for an exam. It really equips you to make, much sharper investment decisions as a future charter holder.
Exactly. It's about analytical depth. So, as you integrate all this, here's something to chew on. Given how ETFs, especially for less liquid assets, can offer that real-time price discovery, how might the growing use and diversity of ETFs, particularly in things like emerging and frontier market debt or equity, fundamentally change how big institutional players approach and gain exposure to those potentially opaque markets over the next, say, 5 or 10 years? Moving beyond just simple index tracking,